Started.
And we're recording.
All right, perfect. All right, well, first off, just want to thank everybody for joining us this afternoon. For those of you that do not know me, my name is Nick Mellis. I'm the Vice President with JF Capital Advisors, based out of New York. This afternoon will be our third installment of JF Capital Unplugged. For those of you that have been with us before, the format here will be relatively the same as what you saw previously. Our aim is to hit about 7 or 8 questions in the 1 hour period. We feel that this is the right amount of time to add significant explanation and significant depth. The other thing which you'll also notice is the fact that we're going to be bringing up some questions that we hit on previously. The reason being that, like all things that are going on in hospitality, it's constantly changing. So we thought that there would be some use to revisiting those and walking through how our responses have changed. The other thing I just want to make clear is the question capability in Zoom. So we'll try our best to knock those out after we walk through kind of our 7 or 8 questions, and anything that we're unable to get to, we will be available to be reached out to after. Another thing to add is that a recording of our webinar will also be made available and sent out to anyone who was signed up. That'll most likely come probably 2 to 3 hours after this ends. So with that, I'd like to introduce my co-panelist, Mr. Jonathan Fallick. Jonathan is the CEO and founder of JF Capital Advisors. His expertise really spans all things hospitality, everything from hotel ownership, hotel development, asset management, transaction markets, also the public markets as well. So with that, Jonathan, I just want to give you a chance to say anything before we break into the questions.
Thanks, Nick. Giving me a chance to say anything is sometimes a little dangerous, but what I would like to say to everyone listening in and that will be listening to the recording is, like everyone else, we've been listening to a ton of webinars. Some are very, very intriguing, some are interesting, and many are just sort of canned and cold. We've chosen to do this without a lot of third-party panelists just so we can give off the cuff, very straight, very direct, really unplugged thoughts and comments on the issues that we keep getting asked. And we're bringing this perspective from wearing a lot of different hats right now as an asset manager, an owner's rep, involved in a number of litigation support projects where I'm an expert witness or we're advising on litigations and arbitrations. We have a number of engagements where we're representing borrowers on forbearances and restructurings with lenders. We have several where we're representing lenders on restructuring and forbearance with and amendments with borrowers. So really some of everything. And believe it or not, 5 or 6 different new ground up developments, which have long lead time, but things are still going on. So with that said, Nick, I think we can get into it, but I just wanted to provide the background and perspective.
Perfect, thank you. Okay, all right, so my first question, Jonathan. So since the onset of COVID, which first hit in the middle of March, there has not been a whole lot of good news for hotel owners. Transient travel is down significantly and there's virtually no corporate travel. As a result, most markets in the US are forecasting a very weak fall before entering into January and February, which traditionally for most hotels has been some of the weakest months of the year. Hotel owners received some sort of a short-term boost with PPP loans in 2020, but those funds and access to capital are beginning to run out. So with all that, how should hotel owners and asset managers generally be approaching the next 6 to 8 months moving into 2021?
The answer is very cautiously. So I agree there's been very little good news. I don't see a lot of good news on the horizon. There are a lot that have been hoping that corporate travel will begin to reemerge next week post Labor Day, but we don't really see signs of that in terms of forward bookings. Will there be a little bit? Yes. Another complicating factor for both families and for potential corporate travel is what's going on with schools. Schools opening, schools partially opening, schools opening and shutting down again. And that's at the university level, the high school level, the middle school and elementary school level. One of the conversations we've been having with most of the operators that we deal with is, an entirely different approach to budgeting, which would normally be an intense process, doing detailed day-by-day budgets and starting, essentially would have started already in July or August with detailed thoughts on marketing plans, on the RFP season and what that means. And we're just seeing it very differently. A lot of it is get whatever business you can, try to not have too much erosion in your average daily rate, but drum up as much, whether it's contract business, whether it's, small corporate business locally, whether it's meeting room rental business for companies that need off-site or training facilities. It's really a guerrilla warfare kind of approach, very cautiously managing the expense side of the business and very cautiously managing liquidity. One of the things I do fear is as operators and owners have 2021 budgets, really beginning in November and in December, and they're presenting them to lenders and they're looking at, based on their budgets, what the cash flow needs are. There are going to be a lot more detailed discussions with lenders as well as with owners about funding working capital shortfalls and funding fixed cost shortfalls.
Got it. Thank you. The next question I have is one that we touched on previously, but one that I want to revisit. So we reached the end of the 90-day forbearance period on many hotel loans from the onset of the pandemic. The initial forbearance was relatively easy to obtain. Most borrowers didn't have to, really commit any pay down or recapitalize a loan. But what's happening with the current wave of forbearance requests? So when are the lenders going to be getting more aggressive with borrowers, and which lenders specifically?
So you made a comment that the first round of forbearances, and we saw a lot of them as 3 months or 90 days for private borrowers. For some larger portfolios and a number of the public companies, many of their forbearance requests were for 6 months, and that's both at the mortgage level as well as the bank credit facility and unsecured bond level. So a lot of the public companies and larger companies ended up with 6 months or 4 months, and they weren't that difficult to negotiate, whether for larger public companies or for smaller borrowers or individual borrowers, unless they were asking for real amendments. If they were basically saying, listen, we're going to have a tough few months ahead. We want the ability to take a PPP loan. We need the ability to close our restaurant or, suspend some brand standards or shut down the hotel or go to minimal staffing. Those were fairly easy requests for most lenders to grant. As soon as the request bordered on or moved into, we want to take money out of FF&E reserves or other reserves and not just defer interest expense, we want to suspend certain obligations, that required a little bit more thought. A lot of the 90-day forbearances are done. Not all of them were done in March. Some were done in April or May. It depended on how much cash was on hand and how quickly borrowers connected with their lenders or servicers or special servicers. What we found was anyone with a balance sheet loan went through that process, generally speaking, much, much faster. And with a CMBS loan, it took longer just to go through the master servicer and into the special servicer process. And it wasn't as easy as picking up the phone and calling your relationship lender. Many of the second set of 90-day forbearances that were also asking for the same things, let us use a little bit of an FF&E reserve. Let us suspend future FF&E reserve requirements for 6 months or 9 months if the brand's okay with it. Let us defer interest expense a little further or defer principal amortization if it's required. A lot of those have also been granted. Where there's been pushback has been where there are additional requests being made. We need to extend the loan because it's maturing in 6 months. We need to extend it further. We want to borrow more than $1 million from an FF&E reserve. We want to borrow $8 million from it. That requires a lot more analysis. And then the ones that require more analysis were where if you look at the budgets or forecasts and the cash flow statements, and it's clear that there, even with a debt service deferral, there would not be enough money to fund operating expenses or to pay property taxes, insurance, but especially payroll.
Right.
Um, the lenders were looking to borrowers to make sure that they were funding the operating expenses and making sure the required fixed expenses, whether property taxes, property and casualty insurance, ground rents, et cetera, were getting paid, so they wouldn't have an immediate problem. So those that were able to, through cash flow or through cash reserves, at the corporate level or owner level, fund operating expense shortfalls, and just defer the debt service, we're having some success. So now fast forward. So we will get to another month, 2 months, and 3 months from now when the second set of forbearances are up. And our thoughts on this are not different than they were a few months ago. We expect that when the 2021 budgets are presented to lenders and the next set of forbearance is asked for, the lenders are going to require something back. And in different cases, it will be different, but that something back is likely to include some infusion of equity. And that infusion should be meaningful. Meaningful is different, depending on whether you're a large public company versus a smaller independent deal sponsor, but meaningful so that you as a borrower are supporting the asset and standing behind it. And so that it's not just the lender making concessions.
Sure.
So we expect that there will be infusion of cash. There will be some plan to either repay deferred amounts starting in 18 months to replenish FF&E reserves. There might be, in some cases, we've seen requests for increased recourse guarantees. So if FF&E dollars that were taken out are not replenished by a certain time, or if deferred interest expense is not paid off by a certain amount of time, that there would be increase in personal recourse and guarantees. That's kind of what we're seeing there. We think it will get more contentious. So far, many things have not been overly contentious. We think it will get more contentious especially as some of the longer term nature here sets in, right? A lot of people were optimistic that by the end of the summer, we would see some uptick, but after Labor Day, we would see corporate. In 2021, we'd see an increase in corporate travel, but we're not really seeing a lot. We're not really seeing a lot of those green shoots and the good news.
Right. And with that, which types of lenders do you think will be the most aggressive?
So it really depends. And when I say it depends on, from a lender perspective, the majority of lenders out there are not actively equipped to foreclose and run hotels as owners. And there's a reason they're lenders and not owners. It's a different time commitment. It's a different risk profile. But what we expect will happen is many lenders will begin a foreclosure process, will begin exercising some of their remedies so that the clock has started. Mm-hmm. And that will put more pressure on borrowers, whether that's through default interest, a fear of foreclosure, a fear of guarantees, recourse guarantees in some places kicking in, whether it's a fear of literally just handing back a hotel or a portfolio of hotels where there's a negative capital basis, a negative tax basis, and literally just handing back the hotel could have adverse tax consequences for the borrower. Mm-hmm. So, do we think that special servicers in CMBS are not particularly well equipped to be owners? There are mechanisms to advance funds for a period of time. What we think will happen in most cases there is if they don't see a path to the borrower getting enough cash to right-size the ship, they may start foreclosure proceedings. Many will look to sell their loans. They'll get appraisals and see if they can do appraisal reductions. But they will, they will in many cases look to trade out rather than complete a foreclosure. Many of the balance sheet lenders in the form of commercial banks, also they're long-term relationship lenders. The vast majority of them do not want to foreclose on good borrowers, long-term clients, but they'll need to take some action if there's no new cash coming to bear. And then the debt funds, which mostly grew out of the private equity landscape, have more expertise in owning, in complex restructuring, and we think they'll do a combination of things. In some cases, they'll be happy to take the keys. In some cases, they will, they will restructure the debt, but end up with a piece of equity or a piece of equity upside via a participation. They may, they may bifurcate the debt so
Sure.
that there's a piece that could be paid current and then a piece that on a future sale could be repaid, so that there's kind of a hope note, and essentially bifurcate. But the debt funds, we think, will be more aggressive than most if their borrowers are not willing to support the assets. If they are willing to, we think most of them will play pretty nicely and be pretty thoughtful about being part of the solution. But if new capital is not coming in, to fund the basics, and the risk is shifted solely to the lenders, we think they'll either take the keys back or foreclose or start that process and ultimately partner up with operators and owners that know how to take over a messy situation. The overriding theme, though, Nick, is, most lenders out there are looking at borrowers saying, we know you didn't cause this situation right now. If there was an issue on a pre-COVID basis last year in December of 2019, that's a totally different story. But if,
Right.
it's not like as an industry, the hotel industry is way over levered. It's not like there was a lot of crazy reckless activity. People were moving along. We seem to be at the top of the cycle, maybe just past the top of the cycle and trending down, but no one had a playbook and no one was, preparing for, the worst operating environment, that we've ever seen and ever conceived of, with no certainty in sight for a real robust recovery.
Thank you. The next question I want to go into the brand side of the business. So based on my experience, the brands have been extremely cooperative with owners through all of this. They've obviously furloughed the majority of their corporate staff. They're working off their own balance sheets. And even, 5 or 6 months later, they're still kind of in like they're for like a triage mode. As a result of this, they've relaxed their brand standards and quality assurance. The real focus from what I've seen is just on really cleanliness, sanitization, and of course, the fire and life safety. So my question to you is, do you think that the focus of brands and brand standards will be as they are currently for the next 1 to 2 years? And do you think that cleanliness, sanitization will come to the forefront, whereas some of the other points of focus will take a step back?
So there's a lot to unpack there. So let me back up for a minute and say the larger brands, the major brand families out there, they did furlough a ton of people. They suspended a lot of their activities, including a lot of their marketing and loyalty marketing, a lot of their digital marketing, a lot of their print marketing, a lot of their group sales efforts are not there, and that kind of makes sense. Now, from the franchisee or owner perspective, you kind of scratch your head and say, I've been paying you fees for all this time. Now I need you the most, and you're laying off people. So, the brands, the big brands, they've got to manage their own balance sheets and their own liquidity. They've also got to provide sort of enough cushion for franchisees, for owners, prospective owners on a longer term basis. So it's a very delicate balance. From a franchisee perspective, the brands from March through today have been extremely cooperative as a generalization, right? So if there was a bad relationship between an owner, franchisee, and whether it's Marriott, Hilton, Intercon, Wyndham, Hyatt, any, right? So not picking on any one specific brand. If there's a bad relationship beforehand, right? You might see some nasty correspondence or somewhat nasty kind of outcomes coming out here. If there was a fundamentally good relationship on a pre-COVID basis, the brands have been very cooperative. They understand that their owners have cash and liquidity issues just as they look at it themselves, right? If they make their money based on management fees as a percentage of gross revenue and some incentive, or royalty fees as a percentage of rooms revenue and maybe food and beverage revenue, and the underlying hotels close, right? There's a huge problem and a huge disconnect. So, the brands are seeing their cash flow get absolutely whacked, and they're seeing a lot of skepticism and nervousness about their forward growth pipelines. That said, they have taken action to fortify their own balance sheets and have gone into the unsecured notes market. They've done pre-sales of points. They've drawn on revolving credit facilities. So the brands actually have massive amounts of liquidity, which is very prudent. And for the most part, they were fairly lowly levered. Right. So if you look at all the big brands, they had very little debt on their balance sheet relative to their overall cash flow, to their enterprise value. So, I think the credit markets were frozen for a month or so, but as we got past that, and the larger, better capitalized institutional players were able to raise meaningful amounts of new debt capital fairly cheaply, and have made lots of moves to basically cut a lot of their fixed expenses, semi-fixed expenses, and a lot of that is through, is through their payroll. So understanding kind of where they're coming from. Then you asked about brand standards. They've been very relaxed on brand standards, trying to make sure that all the health and safety protocols from both the CDC, the industry, local governments, and the brand pieces are being enforced. It's very difficult to gauge enforcement because many of the brand professionals are not actively traveling. So in the normal course, you would have quality assurance inspections where the brands would send out their inspectors and they would go without a lot of notice, maybe a day's notice, hey, I'm arriving, to do a 1.5 day detailed review of the property. You're not seeing as much of that, and you're seeing in the news sensationalized if there is a slip up on safety, hygiene, following the latest standards by brand. Because not all the employees on site everywhere, not every management company, and even within the brands, not every one of their employees has had detailed amounts of training. And there's human nature, that comes into the mix. So I think you'll see the brands get more aggressive on safety related issues. They historically have been very, very focused on things that impact their top tier guests, the ones that have status and elite level of status within their loyalty programs, who are generally their corporate customers, that travel the most, that spend the most. And it's difficult to keep them extremely happy. What's going on though is customers, both corporate where it is and contract and especially leisure, are giving hotel owners and operators a fairly large pass on implementation of certain standards, or most customers are very understanding that employees are, working under tighter conditions. And if a restaurant is closed, but there is a to-go food offering, many customers are understanding of that, right? If, housekeeping is slower, or we say we're going to clean every 3 days, most customers are understanding of that. Some are asking for daily cleaning. Some are saying, don't ever come, I don't want it after 3 days, don't come near my room.
Right.
So, so operators are adapting. But I think the brands will start to be more focused on the cleanliness and sanitization side of it, and the appearance of that, because, hotels have always been very focused on cleanliness and sanitization. All of this, we have a deal with Purell, we have a deal with Lysol, we have a deal with Ecolab. A lot of that is marketing. It's not so vastly different from what was done before, except now we have employees wearing masks. We're wiping down surfaces way more regularly and way more visibly. We're putting a sticker on the door. So it's making customers feel a little more comfortable.
Mhm.
The rooms are getting cleaned in a more thorough format, and that adds cost.
Right.
But I don't think it'll be until sometime next year that the brands get more focused, and late next year that they get a lot more focused on your more typical brand standards, because it's very difficult. It's a very difficult operating environment.
Got it.
Now let me add one more part to that. So without franchisees, for people that have brand managed hotels, a lot of the owners were extremely surprised by brand manager requests for working capital in April and in May. And many got huge requests for working capital for the foreseeable future. And there was a lot of pushback on that, and a lot of pushback in terms of cutting extra overhead, cutting centralized costs, shared costs, et cetera. So that caused like a lot of sticker shock, where owners said, you want me to punch in $5 million, within 30 days. I don't have $5 million.
Right.
I just don't have it sitting there. Or even if I do, I've got 10 properties and not all hospitality. I've got retail properties I'm feeding. I'm trying to figure out what's going on, and you can't give me a detailed budget for the rest of the year, a detailed forecast. And I understand why you can't, but it's very difficult if you say, I need millions of dollars of cash right now. And
Sure.
we've been involved in a number of those owner and operator disputes, most of which have ended in a reasonably amicable solution, where steps were taken to mitigate the amounts needed, and everyone kind of worked together.
Thank you. All right. The next question I want to move towards the capital market side of the business. So with the onset of COVID back in March, the hotel capital markets have been virtually, non-existent for most borrowers of existing hotels. On the development side, this has been even more bleak. I know that this is something that we keep seeing. So my question, Jonathan, is, as a hotel developer with a hotel project that was not fully capitalized or was not under construction pre-COVID, what can be done to kind of push the development to the finish line in this environment? What do the capital markets currently look like, and when do you anticipate them beginning to really open up again?
So before, I'm sure we're going to get a whole bunch of questions on the Q&A button here. And it's true. The hotel debt capital markets for getting new mortgage financing is functionally shut. There are lenders that are making loans, but if they were making a 60 to 65% loan, at LIBOR 250 or LIBOR 300 in February, they're now making a 49 or 50% loan at LIBOR 500. And if it's a 65% loan, there's debt financing to be had at LIBOR 750, LIBOR 800, with the LIBOR floor, with tighter covenants, more rigorous underwriting, and it's got to be, in most cases, it's got to be a strong sponsor, a good asset, a strong story, not a very speculative deal, and that's for existing. For development deals, it's very tough. And it's very tough because it's very difficult to create an underwriting that a developer, that a lender, that an equity partner has real conviction in. What you need to do is, create some sort of thesis on when you think we return to a level of normalcy. Call that 2019, revenue statistics and profitability statistics. Whether that's normal or not is debatable, but when do you return to that? And there's a lot of forecasting tools out there to get there. You can look at the Smith Travel projections. You can look at the CBRE projections. You can look at the LARC projections. You can look at Calibri Labs, and they've got offerings and products that will do a range of sensitivity projections for you, but it's very difficult with a lot of conviction to say this is what's going to happen and when. So if you have a development deal or a major adaptive reuse deal that and you're an opportunistic, 4 to 5 year holder, including your construction period, and you want to build it and sell it, it's very difficult to sort that out. If you have a 10 to 20 year, very long-term time horizon, and you have a good location, you were planning on putting a strong amount of equity into the deal, you have a good operator, a good brand, a good location, long-term market demand drivers, we're seeing a bunch of those push ahead, and it just requires more equity and kind of a mentality that there will be a construction loan of some sort, and it might not be as robust as it would have been previously, but it will get refinanced. So if you run your pro forma and run your deal model and your internal rate of return and NPV model and show, that you're open in a year or so or 2 years after you're open, you do a refinancing, you're basically over equitizing the deal up front and then pulling back some of the equity into a better market environment. At the same time, it's a lot easier right now to get the top-notch architects, engineers, GCs, because a lot of their business has been put on pause, as a result of other projects that are stalled. So it's easier to get those things. It looks right now like it's substantially better from a construction labor perspective. It's easier to get subcontractors. It's easier to get general contractor focus, with good quality crews and foremen and team leaders and project managers. So construction costs should be lower. Equipment costs should be lower. In some cases, we're finding that municipalities are willing to be a little bit more lenient as long as you're not asking them to write a check, give a grant. But if you need approvals for more rooms, more amenities, certain things, removal of some restrictions, and it doesn't require them to write a check or give up meaningful tax revenues in the future, people are playing ball. So it's an interesting time. Same thing, if you were negotiating a deal with one of the major brands or an operator, you could in most cases get better terms today than you could have in February or back in December, because they want to bolster their pipeline with good quality products. So, development will continue, but at an extremely measured pace. Deals that were speculative in nature are just not going to come close to getting financed. Deals that make sense from a true long-term perspective, if they have good sponsorship and a decent amount of equity invested in the deal by sponsors and partners, can get done. And it's not different than what we've seen in the past few cycles, especially in 2009, 10, and 11. Deals continued to get done, but with a much lower, with many fewer of them did. And it took to, seeing the fundamentals really starting to come back. You didn't see a more active construction financing market until 2013, right? And even then, it was still slow and it was more expensive. And by 2014, 15, 16, the hospitality debt markets became white hot.
Right.
And it was lenders were falling all over themselves. So we move very quickly. It's funny because in theory, the absolute best time, right, to build, develop, et cetera, would be right now, right? That's the absolute best time. And one of the other things, we didn't really address, and maybe we will in a few minutes, is in certain major markets, there are a lot of hotels that are either functionally obsolete or just based on their programming, where they are, what they are, existing in-place contracts, union agreements, may never really reopen, or if they have reopened, may never really accelerate to to 70, 80, 90% occupancy like they did before, and will be functionally converted to another use, removing a lot of rooms inventory in certain major urban markets, some suburban markets, but a lot of major urban markets as they convert to multifamily, student housing, senior housing, creative office, and hotel is just not the highest and best use. And, and this becomes a wake-up call for that.
Got it. Thank you. The next question I have, so one of the most difficult aspects of this crisis for hotel operators has just been the inability to plan. The fact that, operators don't know what's going to happen in a couple days, let alone the weeks or the months that kind of follow. So with the possibility of a second wave of COVID cases potentially coming in the fall or even into the winter, how should hotel owners be preparing for this?
The answer is no one knows. Right? No one knows. Everyone needs to remain cautious. We don't know if COVID is going to accelerate, decelerate, what flu season will do to it, what happens with schools reopening, what happens, if people continue with the work from home kind of rationale and their kids are doing, to the extent they have kids, are doing online schooling, you might see a lot more leisure travel than previously expected. And I'll tell you just from my own perspective, we have an 11-year-old who we've just enrolled in a full-time virtual private school that does not have a campus. It's never had a campus. They've been in business since the 90s, really appealing to families that, have kids with non-traditional schedules, whether they're performance athletes, they're performers, they're military families. They just don't have a normal schedule and are moving around. So we've done that, and what that means is if I'm working remotely or just have access to an airport, I'm in Westchester, New York right now, but I could spend the entire winter in Miami or Los Angeles, and fly somewhere if I need to, but essentially just follow the warm weather. I could take a road trip for 2 months as long as I have Wi-Fi and can, do fascinating webinars like this, and do Zoom calls and WebEx calls and Skype calls and beyond, just normal Polycom speakers and conference calls. I can do it from everywhere. So I think we might be surprised by the amount of leisure travel continuing past the summer, but we'll be disappointed by the amount of corporate travel. And there will be some. There will be people that need to get in front of clients, that need to do business, that want to do business, but it'll be very convoluted with different states having different restrictions and quarantine mandates and programs and them changing. And, some of the, we're involved in a number of properties in New Jersey, which as of tomorrow reopens for indoor dining at 25% capacity. We heard that was going to happen over a month and a half ago, and it was called off on a couple of days' notice, right, on 2 days' notice. So we think that will kick in, but what happens in 30 days? Will that accelerate to 50%? Will it go back to no indoor dining? So it's very difficult to create budgets, create staffing plans accordingly. We do have this one other big sort of wild card out there that's, creating a lot of direct and indirect headlines, and that's the November election, or should I say the November through January election, where, we'll see a lot of political posturing by both parties, by a lot of politicians, when it would really be ideal if the focus was on safety for the American, and for all individuals, as well as clear, cohesive guidance coming along that's both scientific and practical, coming along for what we as hotel industry participants should be doing, and we as citizens and residents in this country should be doing. So the answer is no one has a clue. Anyone who tells you they do is wrong. Liquidity is very important. Being able to pivot very quickly is very important.
Got it. Thank you. The next question, I want to spend a little bit of time talking about the public hotel markets. So what's currently driving hotel valuations in the public hotel markets currently, and how are hotel stocks being valued?
So, this is very interesting. So there's a disconnect between the REITs and the C corps, right? The C corps are primarily the big brand companies like Hilton, Marriott, Wyndham, Hyatt, and they got walloped, in the stock market in March, and then they bounced back reasonably well, and they've bounced further back. And if you look at how they're trading, they're still way down from their 52-week highs, but measured on an enterprise value to EBITDA basis, they are far stronger than you would expect based on the current fundamentals. And there are a few reasons for that. And by that, if you look at sort of where they were trading on an implied 2019 valuation, enterprise value divided by 2019 EBITDA, they're trading, a couple of points, a couple of turns below where they were, on a pre-COVID basis, and way above what any fundamentals would suggest. And there are a few reasons for that. One is, at first, all the headlines came out and said, like, oh, every hotel company is going to go bankrupt, and this is the end, and this is terrible. And it is a real severe demand shock, financial shock, operational shock, just mentality shock, right? No one has a playbook for this, but the public hotel C corps, the big brand companies, went out into the markets and they negotiated amendments or waivers of certain financial covenants under their corporate credit facilities. They drew down on their revolving credit facilities. They bolstered their unrestricted cash on their balance sheet so they could demonstrate, we have 2 years, assuming nothing reopens, we have 2 years of ability to withstand this, and they have long-term contracts. And, if you believe the hospitality business is dead forever, you never would have bought one of those stocks. But, the public markets tend to look about 18 months forward. And they looked forward and said, so the C corps have demonstrated the ability to pull cash on their balance sheet, to negotiate credit facility amendments. They've sold a number of points to the credit card companies, right, which means they've got more longer term obligations, but they were able to create hundreds of millions of dollars of cash and liquidity. And then they went out and started issuing unsecured debt, unsecured bonds. And at first the pricing was a little higher. Now the pricing is reined in tremendously. And what the markets have generally concluded, what the buy side investors, the mutual funds, the hedge funds have concluded, is the big brand companies are here to stay. They have enough liquidity to weather this. And going forward, there will probably be more of a push for independent hotels to affiliate with a brand in order to participate in the recovery. There will be pent-up demand. Their business will come back. There will be ways where they can operate more efficiently. So, once you go through 8 years of an upcycle, or 9 years, almost 10 years of an upcycle, you add a lot of corporate fat. And maybe some of it is deserved and warranted, not all of it. So all of a sudden, the brands start to figure out, oh, we can do 90% of the stuff we were doing before with 50% of the people. We don't need as many executive vice presidents if we have vice presidents that are willing to step up and do the same work for the next, 5 years, through this rebuilding, at half the all-in compensation and benefits level, or maybe 2/3 of that level. So the conclusion on them is they're going to make it. They're going to make it, and they're going to benefit, even though their operations will be challenged over the next 24 months. If we start to see that we think this is a 5-year, for the next 5 years, we're not going to see a recovery, you'll see a reset in the stock prices. So then we go to the REITs, right? And the REITs, on an implied cap rate basis, and this is for the entire hotel REIT sector, on a weighted average basis, they were trading at about a 7.5% implied cap rate on 2019 numbers at the end of the year, whether that's February or last December. And now they're trading at a roughly 10.5% implied cap rate. and they have a lot more direct mortgage exposure. They're more levered than the C corps. They have more debt relative to their EBITDA, relative to their enterprise value. But the REITs, as a generalization, as a hotel REIT sector, are much lower levered than they had been in prior cycles. So better debt profiles, less direct mortgage debt and more unsecured bonds, slightly longer term debt maturities, cheaper debt financing. So they did the same thing as the C corps. They went and they got, they pulled down cash from their corporate credit facilities, from their revolving credit facilities. They negotiated waivers under their unsecured bonds and credit facilities, including ability to deploy some money for acquisitions and get offensive. They've started to hunker down with their operators in terms of how to reduce expense. And some of them look to be in big trouble. Those are the ones that were highly levered before. But the others, started a little slower than the hotel C corps, but they started also issuing debt and issuing preferred. So they demonstrated that they're able to access the capital markets, but because they're so real estate dependent, the EBITDA is going to be extremely depressed for the rest of this year, for next year, and depending on whether they have a lot of group houses, big boxes, urban hotels, or limited service hotels, some will bounce back and get to recovery much quicker than others. Limited service hotel REIT and extended stay REIT bounce back a lot quicker than big box urban assets, but the big box urban assets retain long-term value.
Right.
So we're seeing a lot of very skilled REIT management teams in place, working with their operators, coming up with creative ways, and their asset managers working with creative ways to reduce their monthly cash burn, to figure out how to repurpose, to figure out, what a restaurant reopening looks like, what a spa reopening will look like, what meeting space reopens and when, how they pivot from group to contract business to business transient to leisure transient. But they've also, for the most part, proven that they can bounce back. So you asked how instructive is this for the private markets? It's very easy. The public companies have equity research coverage. They get covered by the media. They do earnings calls. They have presentations. Their stuff is a lot more visible. But they also tend to have, sophisticated, experienced management teams that have been through cycles, and by and large, they're lower levered than comparable private hotel owners. So a private equity fund is likely to be, twice as levered as your typical or average hotel REIT, and as a result, when you try to translate it into the private domain, you need a lot more relief privately than the public REITs. So it's illustrative, but I don't think you can take the public market valuations and apply them to private markets, because the public market valuations for both C corps and REITs provide a huge premium for the liquidity that they have, the ability to raise equity if they needed to, the ability to raise preferred equity, unsecured debt, mortgage debt, and to more easily negotiate with their existing lenders. So I would not take public market valuations, apply them to a private situation, just unilaterally do that and say, well, this is where the market is, because where the market is for public liquid securities, is often generally very different from illiquid private real estate holdings.
Got it. All right, so we have a little under 9 minutes remaining. So this is my last question. So as we sit here at the end of the summer, I think we all know that we're in an unprecedented operating environment, which will take the industry, at least a few years to recover. The sentiment's clear and really shared by all the prognosticators out there. On the other side of that, though, Jonathan, what are some of the unintended consequences of COVID that people aren't necessarily talking about? Where could there be potential disputes, and who would those key groups be?
So I'm going to start with the good side of the unintended consequences, because on this webinar and on many others, there's a lot of gloom and doom, and and ultimately we're a very resilient industry. We're a very resilient country. So I don't see the end of the hotel industry. I just think the way we interact with customers, the way we take care of customers, the way people travel might end up being a little different. I think one of the things that we're seeing now is all this focus on contactless everything. That's check-in, that's reservations, that's food, and I think that's good, right? I think that's fundamentally good. I think the hotel industry has been very slow as an industry to adapt to change, right? And that's just a function of some of the big brands and their standards, the fact that we have so many different owners, right? It's not really concentrated ownership if you think about who owns the hotels spread all over the United States. So a push to more technology, and it makes a ton of sense. And I never quite understood where, it's just perfectly normal to go to an airport, not talk to a single person, right? You pull up your phone, here's my boarding pass, here's my thing, you flash it a few times, and you're on the plane, right? You go through security and you're on the plane. And the majority of people going to hotels are not doing the same thing. And I think you're going to see more of that, right? Where they don't want to go to the front desk and they'll check in remotely. They'll check in using the digital key or mobile key. There will be much better accessibility and communication via the booking apps, where you can, get concierge services. You can request housekeeping services. You can request different things through much greater embrace of technology. I think that's very important. I think also the hotel industry, in every down cycle, we figure out how to be a little bit more efficient. In some cases, a lot more efficient. And then as you go through the up cycle, some of that fat and bloat, whether it's brand standards, whether it's more things, whether it's more amenities because you're trying to justify a higher rate, start to creep back in. So here, no one had a playbook. People have had playbooks for a recessionary environment or a demand shock. People have even had playbooks for, a couple of days close or a week close because of some, local event or a weather event or a, God forbid, a terrorist, threat or event. No one listening to this call has had a playbook for, a 6-month plus shutdown, and severe curtailment in travel in the United States, a shutdown of international travel coming in, a massive shutdown of the airline industry, the restaurant industry, with a shutdown of, and shutdown is a bit of an overstretch, but like a material decline in people going and working in offices. It's, no one had a playbook for a shutdown of all the professional sports, right, which have now reopened, but not to live fans. So it's, we're gonna come out of this with much leaner operations, much more focus on what customers really need and what they don't need. What do they want in a room? Do they need 14 different things on a desk in a guest room, or do they want a really good light and really good Wi-Fi and good plugs? Do they need a book? Do they need a Bible? Do they it's a different story if you can, if you can get the Bible, the Quran, the whatever on your phone, or on your laptop or on your tablet. So a lot of things will start to come out of the rooms. I think the, hotel housekeeping service every day is mostly going to go away. There will be questions of, is it going to happen every 3 days? Is it going to happen just on checkout? Is it going to happen as an a la carte service where you can pay for it if you want to? And that will help with labor costs, right? It will help with timing, management, labor costs. Room service, I think for everything except the 5-star hotels and certain, resort environments will go away, right? It was a money loser beforehand. People were generally upset paying $50 for a hamburger, fries, and a Coke or a glass of, cheap Cabernet, and having it come, not tasting so great, not so hot. And they're like, I just got ripped off for $50. And the hotel operator saying, I just lost money on that transaction, right? So that'll go away, right? In certain cases, in certain, in certain types of hotels, it'll continue and it'll stay, and that makes sense. So we will come out of this with better booking technologies, better focus on what the brand loyalty programs are actually driving and doing, better focus on staffing, on ability to do different things. On the downside, um, nothing brings out litigation, arbitration, and disputes like a down cycle and a severe downside environment. So we are in the middle of a number of these, and we're seeing others percolate, and expect they're going to push into full-fledged disputes between owners and operators, owners and branded operators, between franchisees and brands, between partners, between equity partners in different deals where one wants to fund money to preserve the asset and the other says, I don't want to, and the third says, I want to, I just don't have it. There will be disputes with lenders where certain lenders are taking aggressive actions, and and how that's perceived in a court or in an arbitration, may play a lot differently than they think. And same thing with borrowers, right? Or a lot of people are scrambling and doing things that, in hindsight, may not comport 100% with the contractual arrangements that they have, whether it's a ground lease, a loan agreement, a management agreement, a franchise agreement, but they're taking the steps that they need to protect and preserve the asset. So, we're involved in 6 or 7 different litigation dispute matters right now, both arbitration and litigation. Some are far along, some are in early stages, and we've been pinged on probably another dozen or so that we've had conflicts one way or another with. But we're seeing that, and it's going to continue. We do think there's going to be some interesting ups and downs in terms of the property tax world, where municipalities are going to increase millage rates because they have budget shortfalls, but the assessed values of hotels are clearly for 2021, 2, 3 are going to go way lower. So does that mean property taxes are going to go lower, higher? People have differences of opinion, and a lot of that is depending on which municipality. So we think there's going to be a lot of posturing, a lot of fighting, a lot of nasty emails, a lot of nasty letters. Some will not be intended to be nasty, but will be taken as such. And it's going to take a bunch of years to play out. And there will be, hotels and hotel portfolios where the keys are handed back to lenders, and there will be others where, things will be worked out and it will take some time. Nick, you want to hit one or two of the kind of last questions that came in while we were talking?
Sure. We're curious to hear your thoughts on union hotels in New York and the requirements to pay out there like a severance in order to stay closed for the rest of the year versus opening and running huge operating losses.
So we're going to do I believe our Unplugged number 4 is going to be very focused on kind of labor issues, union issues, not just in New York City. So I would say, number 1, stay tuned for that. We'll do it in about 3 weeks or so, during September. But the amounts of potential severance obligation are huge, and the severance provisions in the union contracts in New York and elsewhere never contemplated this environment, never contemplated that, the entire industry would be shut down and owners would not have money to pay severance. It really contemplated, okay, you're shutting down certain divisions, departments, or you're shutting down the hotel because you're converting to some other use and you want to get rid of this. That's not the case here. In a lot of situations, the hotels are closed because you're not allowed to do the events that you otherwise would have done. You can't do indoor dining. There are restrictions on international travel coming into New York. So, in addition to that, you see Peter Ward, the head of the New York City Hotel Union, resigned a few weeks ago. So there's a lot going on. It's way more than sort of a quick answer, but please stay tuned for our September version of Unplugged, where that will be our primary topic and focus. You want to do one more, Nick?
Sure. Regarding the brands, they laid off the majority of their people and packages were given to the more like senior executives. As they reopen, do you see the brands rehiring back all of their management division staffs? I mean, why are they managing limited service properties under 250 rooms? Does this make sense for them?
So this may sound ageist and it may sound inappropriate, but as a practical matter for any business, whether it's, you know, one of the big hotel brands or not, you know, this is the type of environment, a severe downside when, you know, they rotate out of a lot of senior people that, you know, that are very talented, that have had successful careers, and they can actually eliminate headcount going forward, right? So with a one-time payout package, et cetera, they're able to elevate more junior people who are happy for a promotion, happy for more responsibility, cost a lot less. So I don't see a lot of the senior people getting hired back in their same positions at those same brands. I do see some hiring back just as owners need it and as revenue starts to recover. But I do believe that for anything sort of below the luxury level, you'll see a much larger willingness for the brands to convert managed hotels to franchised hotels, where they can put a lot less labor, and create a much higher operating margin for themselves at the brand level by collecting franchise fees, doing QA inspections, you know, doing brand support, but not having as many operational people creating budgets, doing hiring, doing staffing, you know, creating F&B concepts and doing all of that, doing all the risk management, everything that comes along with it. So I think you'll see a bigger push to for the larger brands going to more of a franchise model and allowing quality, talented, independent management companies and strong owners to manage under a franchise model.
Got it. Okay. All right. So we're about 4 minutes past when we were supposed to end. So Jonathan, I want to deep down appreciate all your time and appreciate everyone else for tuning in to our webinar this afternoon. And please look out for our email in a couple hours with the recording, and feel free to reach out with any questions.
Great. Thanks, everyone. And as I said, be on the lookout for information on JF Capital Unplugged #4 coming in September. Thank you.
Thanks.